Hi everybody, welcome to lesson 2 of Unit B in the Money Matters textbook. Today we're going to be looking at the short-term causes of the Great Depression. And we'll also go through the questions that I set you for homework in lesson 1. Remember the difference, short-term causes happen in a short time before the event happened. So today we're thinking about things that happened in 1928 and 1929. The Great Depression started in 1929. So let's start by looking at the answers for lesson 1. Question 1. How did people view the economy during the 1920s and why? Well, there's that phrase, the roaring 20s. Roaring is like a lion, a very powerful noise that comes out of a lion's mouth. And the economy was called the roaring 20s because the economy was very powerful. It was growing very quickly. There was lots of wealth around. Many people were getting more money. People were getting better standard of living. They were able to buy luxury goods because they were becoming more wealthy. What does overproduction mean? Well, overproduction means producing over what you need, or simply producing too much. When you produce too much of something, there is a surplus. A surplus means that you have too much because the market that you're trying to sell to is too small. Why did it happen? Well, it happened because there was lower demand. Because the demand started to go down, people bought a radio, they bought a car, they didn't want to buy a second one. And there was an unequal distribution of wealth, so many people in America could never buy even one radio or one car. So the market was just too small. And also they had this tariff policy, charging taxes on things coming from other countries. And we'll look at that in a bit more detail on the next slide. What were the effects? Well, because factories needed to produce less, they needed less workers. And when they wanted less workers, people lost their job, so less people had money. That meant less people were willing to spend their money, and so there was less demand. And this started the cycle of depression. Less demand means less production, means less workers, means less people have money, and it goes back to the beginning, less demand. Continuing the questions, number 3. Describe the different social conditions of families in the 1920s. Well, there's two basic types of family in the 1920s. Some were very wealthy. They had lots of money for luxuries. These are people that had good jobs. Maybe they're working in offices, or maybe they are professionals, bankers, teachers, doctors. There are a large number of people that have a comfortable life. They can buy a car, they can buy a radio, they can have a holiday. They have extra money left over. But others were living in poverty, and they didn't have enough money even for the food they needed. So these people could never go and buy luxury items like cars or radios. Question 4, I said we'd come back to this. What was the tariff policy? Well, tariff policy was charging taxes, tariffs, on goods coming into the United States from other countries. This meant that foreign goods were more expensive to buy. So the government did this deliberately. They wanted it to be more expensive to buy a Japanese car than an American car. So they charged a large tax on the cars coming from Japan. But in the beginning, this was good. It meant people would buy from American companies, not foreign companies. So in the beginning, this was very helpful for American business owners. But later, the American businesses wanted to export their items to other countries. And the foreign countries had the same idea. Because the US government charged tariffs on items coming into America, other countries in Europe, Asia, also started to charge tariffs on items from America coming into their country. So items from America became more expensive in Europe, Japan, Korea, and places like that. That meant that people in those countries would not want to buy American goods, so there was a very small demand for items from America in those countries. Okay, so now let's go forward into today's lesson. If you didn't have those notes before, you can always rewind and copy down if you haven't done that already. So today's lesson is about the short-term causes of the financial crisis of the Wall Street crash. In October 1929, Wall Street started to go down. Wall Street is where people bought and sold shares. It's the stock exchange. Every country will have a stock exchange where businesses in that country will register their business and how many shares they have. And then people can buy or sell shares by registering with the stock exchange. So when we say Wall Street crashed, it meant lots of people were trying to sell their shares at the same time, and so the prices were going down very quickly. All the long-term causes and the reduction in the consumer market led to a loss of confidence in the prosperity of companies. During the 1920s, more and more Americans were buying shares on the stock market on Wall Street. The share prices kept rising, and there was confidence that this would continue. So because people thought that the share price would keep going up, they bought shares on credit. That means they borrowed money from the bank. If they had 10% of the cost, they could borrow the other 90%. They expected to sell their shares a year or two later for a large profit, and then they would pay back their debt and they would keep the extra money for themselves. This is called speculation. So I wrote down speculation over here for you. You might want to pause the video after this slide and copy this down as well. Speculation means investing money so that later you can sell and make money, make profit. This is always a risk. If the value goes up, you have profit, but if not, you lose and you get a debt. However, during the 1928, share prices did not rise as much as in previous years. So the increase in the value started to slow down. Many companies were not selling as many goods, so their profits were smaller. When people see that the profit is getting smaller than before, they are less willing to buy their shares. And some more experienced investors and bankers began to sell their shares before the values fell. When others saw this, they also copied. So, in summary, in the 1920s, people were confident in the US economy. This was the roaring 20s. People were very confident. They thought the economy was growing. They saw companies like Ford that were making more and more cars for cheaper prices, and many people were buying, so they made a large profit every year. So people were confident in the American economy. People bought consumer goods like cars and radios on credit, and they also used credit, that is borrowing money, to invest in shares. I remember when you were in class, I explained to you that shares are small parts of companies. A company might start with 1 million shares, and people can buy 1 share or 5 shares, 100 shares, 1,000 shares. They can buy as many shares as they like, as long as they have the money to pay for those shares. Well, people were borrowing the money and buying shares of companies because they wanted to also share the profit of the company. But in 1928, the prices started to increase more slowly than before because the companies were selling less goods, there was less demand for their products because of overproduction and the small market and the tariff policy. So the market was becoming saturated and there were less people who wanted to buy their products. Some investors started to sell, but most did not because they didn't understand the warning signs. Go forward to 1929, prices began to fall dramatically as the investors tried to sell increasing numbers of shares. So look, here you can see the prices have been going up for several years. The prices have been going up, and then suddenly in 1929, the Wall Street crash happens, and the prices go down very quickly. On Thursday, the 24th of October, 1929, which is called Black Thursday, nearly 13 million shares were sold. Now, a group of leading bankers spent $250 million buying shares in the hope that this would stabilize the market and give people confidence. So the banks did not want lots of people selling their shares at the same time. They knew that if many people started to sell their shares, people would lose money. And people had been borrowing money from the bank to buy the shares. So if people lost money, the banks were afraid that people would not be able to pay back their debt. So the banks tried to save the economy. By spending $250 million in one day buying shares, the bank tried to prove to people that the economy was stable, that people could trust it, that there was no need to sell their shares because if the economy was in danger, the banks would not spend so much money buying shares. It appeared to work, and the share prices stopped falling. So this would be this point here. So it appeared to work, and the share prices stopped falling. But on Monday, the 28th of October, there was fresh panic and over 9 million shares were sold. So over the weekend, people think again and they start to worry again. So as soon as the market opened on Monday, people try and sell their shares again. Finally, on Tuesday, the 29th of October, more than 16 million shares were sold. And people were selling for whatever price they could get. You know, supply and demand. If many people want to buy and there's not enough items for everybody, the price will go up because people need to compete. But if many people want to sell and not many people want to buy, then the prices will go down. People are competing to find a buyer. So the price goes down until somebody agreed to buy. So that's why the Wall Street crash led to the share price going down very quickly. More than $8 billion or $8,000 million was lost on that one single day. More than $8 billion was lost in one day because the share prices go down so quickly. That was the single worst day for the stock market. But share prices continued to fall for the next few weeks until they bottomed out. Bottom out means they got so low that nobody would sell for less than that, so the price stops going down. By then, the damage had been done. In 1929, let's have a look at the summary. In 1929, the value continued to rise slowly and then later began to fall. On 24th of October 1929, nearly 13 million shares were sold in one single day. Supply and demand is the idea in economics that when many people want to sell, the price is going to go down. This started a panic, with many wanting to sell, even though that they would make a loss. Remember, they borrowed money from the bank. They had borrowed money to invest, and they might sell for a loss, and at that point, they would have to pay back a debt to the bank. But they still continued to sell until mid-November, when the prices bottomed out. This is the short-term cause of the stock market crash. These are the few days before the stock market crash. You can see that people had no confidence. You can see that many people wanted to sell, and so supply and demand meant that the prices went down very quickly. There was a panic. People were so worried that they try and sell at the same time, even though they would make a loss. Okay, hopefully you've been writing down those summaries. Now, at the bottom of this page, you can see these questions. There are 5 general questions, and there are another 2 questions based on the graph and the table. So answer the 5 questions first, and then when you finish that, look at the graph and the table that's underneath the graph and answer these 2 questions. Complete all of that before Tuesday next week, when we'll have our next social studies class.